Hello, this is Doug Gerlach from iClubcentral. Welcome to our Investment Club webinar for Tuesday, July 19th, 2022. Tonight, our topic is understanding risk and return in your investment club. We're going to be talking about some concepts of risk, volatility, measuring your performance, and how it relates to your investment club, as well as to your individual investor portfolio. But these are topics that often don't get addressed in many of the better investing presentations and the investment club presentations that we do. And there's a lot to take in. So let's get started. Tonight, I will be joined by Russell Malley, who is our club accounting advisor. Sean Pulrang is off for the evening, so he won't be joining us, but Russell is joining us from California. I'm in Connecticut. We're a truly cross-country webinar on this hot July evening. The PDF is available in the handouts tab, so grab that, save it for future reference, print it quickly, take notes as you go, and the questions box is also available in the GoToWebinar application, so you can type those in at any time. Russell will be handling the back office chores for this evening's presentation. So let's start with the basics of risk, return, and volatility. What exactly do they mean and how do they relate to our investing portfolio, especially with respect to stocks? When we broadly define risk, we can think of it as any uncertainty that has the potential to negatively affect your financial situation, including things like market risk. How do the market conditions affect your investment? Something that's on the minds of many investors now as we're in a bear market, and it should be fairly clear for most of you to understand that bear markets adversely affect the value of your portfolio, and that is an instance of market risk. Business risk is also something that we face as stock investors because the decisions that management makes, whether they're going to expand or merge or how they're going to deploy capital, that can affect the value of your investment in that company. Political risk and currency risk, even if you don't own companies that are headquartered outside of the United States, there could still be political risk and currency risk from the operations of the companies that you do own that derive from foreign countries. Liquidity risk, is it easy or hard to cash out of your investment? For instance, real estate might be a desirable asset class, but it is not very easy to sell a property very quickly and convert it to cash. As opposed to stocks, if you need cash, you can sell them immediately and reap the cash from that investment. And concentration risk, are all of your eggs in one basket? Are you under diversified into one sector or one industry? These are all elements of risk that we talk about and that can be understood. There are three types of investing risk that we should be aware of as individual investors: systematic, non-systematic, and company risk. Systematic risk you may know as volatility or non-diversifiable risk or market risk. Systematic risk affects the overall market, not just a particular company, a particular stock. It is unpredictable and it's impossible to avoid. If you're invested in any portion of the market, you are subject to systematic risk. You can't mitigate it through diversification. You can reduce systematic risk in your portfolio by asset allocation. That is, owning assets that are not stocks, for instance, or via hedging. But those are more complicated strategies. We often use beta to measure how volatile an investment is compared to the overall market. I'll talk a little bit more about beta in just a bit. Now, there's also non-systematic risk. This is the diversifiable risk or the unsystematic risk or residual risk or specific risk. These are the risks of investing that you can reduce through diversification. These types of risks that might affect your stock portfolio include new competitors that come on board and undo all of the hard work that a company has done, regulatory changes, management changes, product recalls, and all the things that that relate to the underlying business of the company. You can also reduce the non-systematic risk in your portfolio by adding uncorrelated holdings to the portfolio. So for instance, if you are concerned about regulatory changes in the utility industry and how that might adversely affect your particular holdings, you might instead make sure that you're holding a type of stock that, or a type of or a stock from an industry that is not affected by that type of regulatory change. So we do this as part and parcel of our strategy to diversify a stock portfolio. And then finally, there's company risk, which you may be familiar with as a stock investor. It's the uncertainty that you face when you're owning a specific business, and you are subject to the ups and downs of that company's performance. You can manage company risk in your portfolio by diversification, by owning additional companies up to a certain point, by owning uncorrelated assets outside of the equity asset class. So those types of company risks can be managed in your portfolio. But the key thing to remember is that investment, when you're investing your money, returns always bring risk. There is no such thing as a no risk, high return investment. The level of risk that's associated with any investment that you might make correlates with the level of return that you might achieve. So if you're willing to take on riskier investments, in theory, you should be able to be rewarded for that risk. And the trade-off is that higher returns always bring higher, greater risk. So when we think about this in the real world, we think that stocks are, quote, riskier than corporate bonds, because in most cases, you will earn a higher return from the stocks asset class than the corporate bonds asset class. Corporate bonds, on the other hand, are riskier than treasury bonds or bank savings products. The treasury bonds and bank savings products are often considered very, quote, safe, but they also don't have a very high rate of return. So that trade-off is something that we always make as investors. When you look at various asset classes, this is why investment clubs are urged to focus on the stock market. These have the highest average annual returns over the long term. It's over 10%, closer to 11% or 12% a year over the long term, and that is an excellent rate of return. Corporate bonds have a rate of return around 6% a year. Treasury bonds have averaged in the past 5.5% a year, and then when we look at cash equivalents, such as the short-term treasury bills, those have averaged 3.5% per year. But that goes without saying that there are long periods where these asset classes may deliver higher or lower rates of return. And as you go down this list, we start with stocks. They have the highest level of risk, and we work our way down to cash and cash equivalents, which have the lowest levels of risk in these categories. If you are an individual investor, there are many ways that financial advisors will help you to determine the highest levels of risk and return in personal portfolios by diversifying into several asset classes, including, for instance, in this chart from Fidelity, US stocks, foreign stocks, the bonds, and short-term investments. On the right side, an aggressive growth investor might not have any short-term investments, whereas a conservative investor on the left has a high level of short-term investments. And you can see the table down below. The average annual return for the aggressive growth investor on the far right is 9.65%, compared to 5.96% for the conservative portfolio on the far left. However, the worst 12-month return for this portfolio historically for the aggressive growth portfolio could lose 60.78%, whereas the conservative portfolio could lose 17.67%. That's the worst return in history for this asset class, or this mix of asset classes, I'll say. So at the bottom of this, we have the percentage historic volatility. And so as you kind of take in these numbers, you can begin to see the aggressive growth in a portfolio experiences much wider swings in returns, and that also that volatility means that there is higher risk in that portfolio by that measure. Now, when we talk about investment clubs and asset allocation, this is something that I urge clubs to don't worry about, that clubs should be fully invested in equities, mostly US equities, but you might have some ADRs, I think that's as well. And this is following the approach of an equity mutual fund that strives to be an all stock fund. And the advantage for this is that it allows the individuals, members of your club, to slot in their club portfolio as part of their personal allocation to equities. If the club is trying to be a self-standing investing vehicle that's investing in all sorts of different multiple asset classes and trying out different things, it makes it very difficult, and it's actually unfair, for instance, for a newer member to come into the club where the club is investing in bonds and corporate bonds or treasury bonds and is trying to mitigate risk within that particular portfolio by holding those asset classes and thereby accepting that lower rate of return. But that's not appropriate for a young person, a 20-something or a 30-something may not need to be that conservative where they're trying to strive for ultimate growth. So I firmly believe that clubs should stick to stocks, keep it simple, don't worry about the asset classes, and we'll talk more about how risk and return works in those cases. Now, when we talk about risk, define it in lots of different ways. We can also measure risk, and financial academics usually refer to risk as volatility. And I try to keep the math pretty simple here in the explanation so that you don't need to be a mathematician, but volatility is technically defined as the measure of dispersion of returns for a given security or index. In other words, how much does the stock gain and lose typically? And you can measure this as the variance between returns compared to the security or market index, or using something called standard deviation. And when we talk about volatility, what we're saying is this stock is riskier, but only in the short term. It's really not useful in the long term. There's really not anything that we consider long-term volatility. Volatility is how your returns, how the price of an asset jumps up and down in the near term over the course of a couple of weeks or a year. It doesn't reflect how much the asset goes up or down over half a decade, for instance. And when we're selecting asset classes that have a tendency to grow over time, when we're investing in stocks that we think are going to grow over time, that volatility over the long term is always going to have an upward bend to it. So that's another way to think about volatility when we're looking at our markets. Volatility is normal. There's been an uptick in volatility in the last couple of years after a period where volatility was very slow. Here's a graph Fidelity a couple of years ago, and the light blue is the Chicago Board of Exchange Volatility Index, the VIX, and the green line is the S&P 500. And they've called out some of the major market moving events. And you can see on the far left concerns about China and trade and interest rates caused a spike in volatility in 2015. And when volatility goes up, the S&P 500 tends to fall. And so you can see a big drop there in the third quarter of 2015. Likewise, as oil prices were falling and there were concerns, the volatility spiked again and the market fell again. And then for these little events like the election in the US in 2016, the Brexit vote in 2016, you can see, again, the volatility spiking and the market falling. And finally, over in 2018, when we had concerns over trade imbalances and tariffs, again, volatility spikes and the market declines. But you'll also notice that the green line, the S&P 500 index, is moving upward over time. It's always moving in that upward direction, and that is part and parcel for the the way the market works. Now, another way we can talk about beta with respect to an individual security is, or to talk about risk is for an individual security is with a concept called beta, which measures how volatile an investment is compared to a market. So in stocks, we usually compare a stock's volatility to the S&P 500. In this case, when we look at beta of 1 means that the security has the same systematic risk as the broader market. So it tends to move right along with the market. If the market goes up 2%, that security will go up 2%. If the beta is greater than 1, the investment has more systematic risk, but that also means you've got more potential return in a rising market. It means that in a falling market, it will fall more than the market, but in a rising market, it will rise more than a market. So many times stock investors who are focused on the long term seek out stocks with higher betas higher than 1 to capture a little bit of that extra return, because they believe that markets always rise over time. And so they're not worried about the downside as much. If a stock has a beta less than 1, it means less systematic risk in the market, but with more potential return in a falling market. Sometimes these, the stock, if the beta is much less than 1, if the market goes down, those securities will go up. And vice versa. So holding low beta stocks in a portfolio can be a hedging strategy, but it also can hold back returns if you're focused too much on low beta stocks in a growth-oriented, long-term focused portfolio. I think beta is something that it is worth some study and understanding, because in most markets that are rising, you'll see that your stocks with higher betas are the ones that are delivering the most return for your portfolio. So it brings the concept of risk and return home pretty clearly. Another way of measuring risk is with standard deviation. It's often used as a measure of volatility. It's a math. This is where the math starts to get a little tricky. We're going to try to keep it simple, but the standard deviation is a calculation that shows how the price of an asset, such as a stock, deviates from its average price in a particular period. So you'll look at, in order to calculate the standard deviation, you look at all of the prices in a period. So they might be daily prices for a year. And then you're going to find the mean price. So the mean price is the price right in the middle. It's not the average, but it's the price right in the middle of all of the data points. Then you're going to calculate the difference between each price in the period, so each day's price, and that mean price. That's the deviation. And then you'll calculate the typical standard deviation of any price to any other in the period. And so there's a bunch of calculations that go on after that. But the idea, if you can think of all of those daily prices, each one of them being a point in the data set, and then that mean is the price that's right in the middle of all of those prices, and what is the variance between, you know, the lowest prices and the highest prices over time. And so we break up that range into standard deviations. And so within, you know, 1, 2, or I think within 3 standard deviations, something like 95% of the prices in that period will include that mean price. So, or that any price will be within that those 3 standard deviations. So, kind of a tricky mathematical concept, but we do have some graphics here that will help it a little bit. There's a concept in professional portfolio management called the efficient frontier, which essentially says that you can have investments that are not going to deliver. There's a limit to how much return you can earn based on the risk as measured by standard deviations. So this graph, return is on the left, going up, risk moves across the bottom towards the right. There are several different mutual funds here. And starting on the left, low risk, but also low return are money market or government treasury funds, moving up to investment grade corporate bond funds, blue chip stocks next, and then mid cap funds, and then finally small cap funds at the highest. So when you're looking at mutual funds, for instance, it's possible that you would find a a small cap fund that has the same amount of return, or the same amount of risk, but lower return because of the definition of the efficient frontier, where that boundary is. And that would tell you this is not a good investment for you. That's not optimal. So this concept, again, not as relevant for us as individual investors because we're not building out, we're building a portfolio that has attributes from small, large, and mid-sized stocks, for instance, if you're a Better Investing member using the stock selection guide. But it is a concept that helps you to remember that risk and return are tied together, and you're not going to earn excess return over time without accepting risk in your portfolio. When we talk about investment risk, there are a couple of ways that you as individuals and as investment clubs can manage investment risk. Asset allocation, as we talked about, when you hold different assets such as stocks, bonds, real estate, cash, you increase the probability that some of the investments will be doing okay, even if the others are flat or losing value. Diversification, we spread our money into different asset classes or among different categories of investments in a particular asset class, such as small, mid-sized, and large stocks. Hedging and insurance are strategies that professional investors often use. They can be expensive. They may reduce your returns because there's a cost for the hedging or for the insurance, and they might involve a little more speculation. So, for instance, you might buy a stock and then sell or buy an option to sell the stock or to buy the stock when it's at a lower price, right? And so if the stock falls, you would have the opportunity to switch positions and capture some of the return. When you focus on the long term, however, as individual investors, this is an investment risk strategy. And I think that a lot of investors don't recognize that our long-term approach to the market is a way of managing risk, because we're not worried about short-term volatility. We don't get nervous when we have a bear market. And when we hear the headlines that say the market is crashing, we are not concerned because we understand the history of the market. We understand the mechanisms that go into making the economy and companies grow over time and deliver appreciation via their share price to shareholders. So that is a risk management technique. We don't need to get fancy. We don't need to be buying options. We don't need to be engaged in other behaviors, such as trying to time the market to avoid the element of risk. If we just hold the course over time, we will perform well. Now, that leads us to another way of considering risk. Because volatility is short term, we're not really concerned about it. But another way of thinking about risk is a measure of how much you might reach or meet your reach or miss your long-term goals, right? And so if we think about it, some examples: if you are holding cash in a low interest bank account, then, and that's your only investment for retirement, the risk you run is that you're just simply not going to earn enough, and you're never going to be able to retire, or you won't have enough money to retire successfully. So I would say this is an example of a high risk strategy, trying to guess the near-term direction of the market, deciding to sell because you perceive that the market is going to turn around, and you're going to pull your money out and then put it back in. That may also prove to be fatal to your portfolio and delay retirement. And so that kind of behavior, where you're trying to do something that's unproven by guessing, which is really all that you're doing, the direction of the market in the short term, leads to a high risk behavior. On the other hand, if you're investing in a broad-based all equity portfolio in your 401k, and you're putting money in on a regular basis, and you're not trading, you're just simply investing in a portfolio of index funds, that will probably deliver solid long-term returns that allow you to retire on time or perhaps early. And so that would be an example of a low risk approach to your investment portfolio. And so anytime you try to avoid risk, if you're so terrified of risk, if you're so terrified of short-term volatility that it causes you to make adjustments to your portfolio, and those adjustments cause you to earn below average return on your investments, again, I would categorize that as high risk behavior. So I think this is very useful for those of you who might be in a club where someone says, oh, we should be buying more dividend paying stocks because they're more conservative, they're more stable. What is your real objective of your club? Is your objective to be a stable investment vehicle, or is it to earn the maximum growth that you can over time? And that's for every club to decide. And if you make that decision, then you have to live with the consequences of the rates of return that you'll earn. And this is where we start talking about how we measure investment returns. We'll start at the basics. There's a concept of simple return, which is the percentage change of an investment's value. Sometimes we call it the cumulative return. Sometimes if you'll see junk email or messages on a message board that talk about a stock that was recommended and it earned 600%, we take those kinds of claims with a grain of salt because we don't understand, we don't know what is the 600%. Is this a simple return over 20 years? Is it a compound annualized rate of return from a short-term holding period? So simple return, can be used deceptively, and it doesn't really tell us very much about how well a portfolio or a security performs because it's missing that all-important time value. Here's an example of a club that invested in a stock. They invested $2,000 in it. The blue line is their investment. The orange line is the value of that investment. So immediately they made the purchase. The stock increased in value. At some point they made a second investment. So the stock continued to increase, but then at some point the stock fell for a time and was below. They had actually lost money in that security based on the total amount that they had invested. And their simple rate of return over 4+ years before dividends was 7.2% over 4 years. So, again, our target is 15% a year, but this was for a total period of 4 years. 4.5 years was 7.2%. So that's not a great rate of return, but it doesn't really, again, tell us very much without having some context to it. And the context that we like is the total return, which is the actual rate of return, usually including dividends of the price percentage. And we typically see these presented on an average annual compounded rate. On the stock selection guide, there's projected total return. That's a different concept. So we're looking at the actual earned total return, not the target return or the projected return. And that does include the time element. Sometimes you'll hear this referred to as compound annual return or compound annual rate of return, CAR or CARR. It's very complex to calculate. You can plug the numbers into a spreadsheet, but what the spreadsheet is doing in the background is thousands of calculations and guesses to try to come up with a rate of return that matches the data that's put in. If you learned, like as I did when I was a kid, how compounded interest rates worked on loans or on bank accounts. This is a similar concept here. We're using the internal rate of return calculations to take into account the points in time in which an investment was bought or sold. So if you reinvest in a second lot of a security, you've got multiple cash flows. If you're reinvesting dividends and making purchases, there are more cash flows. If you sell a portion of holdings, there's more cash flows. So we're going to take into account all of those cash flows, all the money that went into the security, came out of the security, were earned by the security, and then this rate of return is going to be presented on an annualized basis. And so when we do this for a whole portfolio of stocks, we can compare each one of them, the stock that you've held for 12 years compared to the stock that you've owned for 4 years, and that annualized compound annual rate of return will allow you to say, okay, well, the stock that we owned, we bought 12 years ago, actually has performed better than the stock that we bought 4 years ago, even though on a simple return, it might not be quite the same. When we look at the same stock that we saw before, the compound annual rate of return was 4.17% compared to the simple return of 7.21%. Because we held that stock for 4 years, the annualized rate of return came out to a figure that was much lower. So this would not be, to hold a security for 4 years and only earn 4+% a year would not, for most investors, be a successful stock investment. Now, when we talk about compound annual rates of return, we have to keep in mind that rates are calculated based on a 12-month and a 1-year period, even if a year of history is not available. So everything is extrapolated to 1 year. So in this case, this is a purchase of Apple in November 2016. It immediately performed very well, and the security, the investment of $5,500 became $7,600 by February of the next year, and that compound annual rate of return was 300%, and that's for a 3-month period. Well, again, this is where you should be able to interpret what's going on and say, well, but this security is not likely to continue this type of growth where it's going to grow $140 every 3 months for the rest of the year or the rest of the holding period. So it's not actually going to earn us 301% over the course of a year. So it requires interpretation. The results are not relevant for any investment in a short period, or especially for large price movements that come in short periods, such as this. So we see, the simple return is, from $368 to $509 is nowhere near 300% on that annualized rate of return. So keep that in mind when you're looking at your club valuation statement. You can turn on or off the compound annual return in the valuation statement and the member status report. And my recommendation for new clubs is you turn it off, don't look at it for your first 2, 3, 4 years of existence, because the numbers will tend to be not very relevant. They're going to be low relative to your expectations because of expenses, because of startup costs, because you don't have any stocks with a long holding period, you don't have a robust portfolio. So we suggest not paying attention to it. But after 4 or 5 years, you can start to look at those values. For an individual member in my iClub, you can display that compound annual rate of return. And again, that gives you a sense of how you as a club member have seen your capital perform for you by being part of this investment club. So the return calculation includes all the member deposits, fees, all the allocated income at year end, any withdrawals. So there's a number of cash flows per year, and this is how members can have a similar total amount invested, but they have different ending cash values, unit owns, and compound annual rates of return. Because for instance, someone that was in the club for 2 months, putting in $20 a month, someone joined, it was only in for, 2 years. Somebody joined the club, was only a member for 1 year, and put in $40. At the end of that second year, both those members have the same capital paid in, but they have units at different values and rates of return at different values as well. Here's a sample member status report, and you can see the rates of return. Some of the members have quite a bit. The second highest rate of return is on the fourth line. Candy's got a compound annual rate of return of 9.86%, even though she is one of the smallest, has one of the smallest holdings in the club. And this is the curse often of being a founding member, because the club gets together, nobody knows anything. A couple of years later, the club is humming right along, firing on all cylinders. Someone joins and immediately reaps the rewards of all of the hard work that the founding members put in. But over time, everyone kind of evens out. And this is something that you should take a look at in your own club, especially now if your unit value is low and your club allows it. My recommendation during bear markets is up your monthly contribution. Put in some extra money into your club while the unit value is low, and then when the unit value starts to go back up again, as your stocks start to recover from the bear market, you will be earning a slightly higher rate of return than other people in your investment club, because you had the smarts to put that cash in when the unit value was lower than usual. So when we talk about performance, how's your club doing? What we really need to do is figure out, what are we measuring? What is good? And the way that we do that in myiclub.com is by something called benchmarking. It's where we compare the results of your portfolio to a representative index, such as the S&P 500 or the Wilshire 5000. We use ETFs, or index funds, that track those, that have very low expense ratios. So it gives you kind of a real world example. The idea is, instead of paying your monthly dues to your club, what if you bought the S&P 500 index fund? How would you perform in that case? Then we'll make that determination. You could also, on a more advanced level, personally, if you were managing a portfolio, and you might divide up your capital into an aggressive small company mid-sized portfolio and a more conservative blue chip large cap portfolio, and you might index those different portfolio segments to a different benchmark, and not worry as much about your broad market return, if you wanted to. It's not something that you can do with a spreadsheet unless you're willing to really dig in and build a model that can handle hundreds or thousands of cash flows. And you need pricing for the index, but the computer software, this is perfect job for it, and we've been doing it on the My iClub site for close to 20 years. So this is something that has been well vetted for us and works pretty well. The performance report, or the performance and benchmark report, calculates that compound annual rate of return for your club and then compares it to market indexes for various periods, such as year to date, lifetime, past 1, 3, 5, 10 years. And we match every transaction in your club, every cash flow going into the portfolio, coming out of the portfolio, every expense, every dividend, every interest item as a purchase or sale or income in the underlying index. And you end up with something that looks a little bit like this. So the key down at the bottom tells you the blue shaded bars are the club, the green is the S&P 500, and the golden is the 20-year Treasury bond. So you can see that for many of the periods, if this club's objective was to outperform the S&P 500, the lifetime, which is the second set of data from the left, they're falling a little bit short. But the year to date on the far left, they're doing quite well. So maybe they're turning things around. Their 1 year is also pretty good, but the 3 years, the 5 years, the 10 years they're trailing that broad market by just a little bit. You know, as a 10-year-old club, you would hope that you know, at last they would be getting their act together, and so this might be a wake-up call for a club like this to kind of figure out what's going on. Why did the portfolio not perform better? Why are we trailing the S&P 500? Or are we improving with that 1 year and year to date returns, showing that maybe we're right on track and the decisions that we've made are helping propel us forward? So again, this is the sample of that report. You can select different indexes if you wish, so you can compare yourselves to other indexes other than the S&P 500. The defaults are the S&P 500 and the Wilshire 5000, representing the broad market. There's also the Dow Jones Industrial Average. If you were really a more conservatively focused investment club, that might be a choice. But I think this is a good idea for clubs to determine what's your benchmark, what's your measurement going to be. And again, after a few years, this data becomes much more relevant and you can make decisions, some slight pivots in your behavior to try to capture some increased return if you're falling short. Always longer term results are more meaningful. So don't get, you know, it's hard. I know when you have a good year, but the longer term results are really more meaningful. And for newer clubs, it can be a little disappointing when you think you're doing pretty well, but those startup costs really eat into returns for the first few years. Something else to consider is that there's often what we call the education premium. So most investment clubs are built on the model of trying to educate members. And so if those club portfolios are trailing the broader market by a little bit, that's okay, because the education you're gaining and the education your members are acquiring from the club and taking back to their personal portfolios, it's a very inexpensive way to become more experienced with analyzing companies and building and managing a portfolio. So how often should clubs take a look at this portfolio report? I think ignore it for the first 3 years. You don't need to focus on it. And then after that, I think it's part of the year-end process. In January, after the books are closed, you might schedule at that January meeting, having a review of performance and setting some objectives for the current year. What did we do right? What did we do wrong? What were the winners? What were the losers? Are there some changes we should make? Should we be focusing more on mid-sized companies instead of mega caps, et cetera? But just always keep in mind that long-term results are more useful than near-term or short-term results. If your results don't exceed the market, some things you might look at: if your expenses are too high, if you're biased towards large and mega cap stocks, or underrepresented from small and mid cap stocks. If you have too many stocks, that can cause your returns to regress to the mean, which is to say that if you've got a portfolio of 50 or 75 stocks, that your returns will tend to match the broader market without an appreciable decrease in risk. So my rule of thumb is 20 or maybe 30 for a mature club that's got a lot of assets, a couple $100,000. Are you holding on to your losers too long? Are you holding on to winners when they are appearing to be overvalued? So there are a lot of fundamental things you can take away from understanding how well your performance has been or not been when you're looking at those reports. So let me leave you with a couple of tips on volatile markets for those of you who are still worried. Here is a graph from 1980 to 2020 of the growth of $10,000 invested on January 1st, 1980. If it was in the market for the entire 40-year period, it grew to $708,000. If it missed the 5 best days out of all of those days, the ending value of that portfolio was $458,000. If you missed the 10 best days, the ending value was $341,000. If you missed the 30 best days, it was $135,000. If you missed the 50 best days, that portfolio only grew to $62,000. So if you think you can predict the market, are you sure? Because missing out just a couple of the best days can take a real toll on your portfolio performance. Invest regularly despite the volatility. When we look back, going back to the 30s, severe recessions, depressions that occurred, coming out of those, great gains were made by investors. The markets really rebound pretty high, and the 5-year returns after those dramatic events, you can see on the March 2009 Great Recession, 5 years later, the markets had gained 178%. 5 years later, in 1994, the Fed tightened. 5 years later, 251%. So we see big returns coming when the market bottoms out, when there is a lot of volatility. Take advantage of the volatility. Swap out your current holdings for higher quality companies. When we look around right now, there are a lot of stocks that are a lot less expensive than they were a year ago. And so in many cases, you might be able to say, well, here we've had this company. It's performed okay, but here's the company that's really a leader in this industry group. Maybe that's time to make that switch. As we head into the year later on, you will start to talk more about tax loss harvesting. But if you've got some stocks that are down right now, you can think about offsetting any gains you might have or capturing some tax losses by selling stocks that you're being held at a loss. Just beware of the wash sale rule. Continue to invest in your IRA, your 401k, your investment club, your regular investment portfolio. Turn it up a notch with those regular investing plans. If you transfer, a certain amount of money every month into your brokerage account or into a mutual fund or ETF, now's the time to up the ante and kick in a little extra. Stay disciplined now more than ever. This graph shows in the blue shaded lines are the stock fund inflows and outflows of new cash. So when those blue bars are moving up, that means there's lots of new cash moving into US mutual funds. When the blue bars are going down, it means that people are taking their cash out of the market. So right in the middle of the graph in 2008, 2009, you can see investors got spooked. They took their money out of the market, and then the total return line there in the orange, spiked, and those people were not in the market to capture those returns. So that's the downside, and the reason why we don't try to time the market, why we don't try to guess the direction, because investors historically have been very, very bad at it, so end up doing exactly the opposite by selling high and buying. Selling when the market is low and buying when the market is high. So keeping our discipline helps us to avoid those types of problems. So with that, we've got a couple of minutes if you've got a couple of questions. Otherwise, we're going to wrap it up for this hot July evening. I hope where you are, you're staying cool and you are not sweating it, especially over your investing portfolio. We certainly have lots of stock ideas as we look at the Investor Advisory Service and the Small Cap Informer issues coming out this week. There are some really interesting high quality stocks available at very reasonable prices. And I think those are the types of companies and opportunities you should be continuing to look for in your investment club portfolio. So with that, let's wrap it up. Thank you, Russell, in the back office. Thank you, all of you, for turning out. And we'll see you next month in our Investment Club webinar. Be sure to click the videos item on the menu bar of your My iClub Investment Club website for the complete upcoming schedule, as well as the link to our archives. So we moved that over right on the My iClub website into your club website, so you have full access to our video library of all of our past presentations for treasurers and club members alike. Please feel free to share the replay of this webinar with your fellow club members who might be concerned about risk, return, and volatility in the market, and hopefully it will help them to understand better how to be a better investor over the long term. Thanks
Doug,
again. We'll see you next time.
We
Russell,
have a late question. I don't know if you want to answer it. Steve is asking, what about R-squared values?
Well, we look at R squared to measure the coefficient of growth when we consider the plotted points on the stock selection guide, and so it really doesn't tell us anything about. It tells us a little bit about volatility, but I'm not aware of a context in which we look at it from a predictive point of view, or because we're looking at the R squared of growth, the R squared of earnings and revenue growth historically, and not the change in the asset price, that is the change in the stock price. So I'd have to think about it a little bit more. I don't think that it really approximates the same classification of risk that we've been discussing. Again, we can look at risk as in that broader context, that the chance that an investment that we make doesn't work out. And certainly one of the things we do as stock investors using the better investing approach is try to minimize the potential for the stocks that we select that they will not perform or they will underperform. And the way that we do that is by focusing on the quality metrics, such as the consistency of growth, strength of growth, stability of margins. So I think, yes, we're kind of onto something with the better investing approach. Part of our approach to risk is to stay away from securities that don't fit and securities that might not have the fundamentals that will allow them to perform over, a 5 to 10 year future period. I hope that makes sense. Kind of musing off the cuff there, but I think that's that is part of what we do as investors, constantly making sure that we're staying on top of our education, learning new concepts, and thinking about things, reframing our knowledge in new ways so that it makes more connections in our brain.
Steve, that's maybe a good topic for another webinar.
Will do. All right, with that, we're going to wrap it up. Thank you, Russell. Thank you, Steve. We'll see you all next month at our next Investment Club webinar.